Now, to help you see why we're looking at this direction, remember there's other methodologies, and I'll make a comment or two about those in just a second. But as an example, we have a portfolio that has 3 tax lots in them. People bought them at 3 different times at $40, $60, and $80. You've got the totals in that chart that sits on the top there. Now, if we follow the low-cost methodology, if we sell one of those shares at one point in time, I've got 2 examples. One where you sell the share at 20, and the second one is where you sell at 100. Well, if we use a low-cost methodology, it's always going to go back to this lowest cost position, which is the $40 that you see above. So with that sales price and the use of the low-cost methodology, you're going to see a capital loss of $20, or conversely, on the sale of 100, you're going to see a capital gain of 60. Alternatively, if we use this high-cost methodology here, doing the same thing, if the price does go down and you have a sales price of 20, and we use the high cost, then we get to recognize a tax loss of $60. Well, that's valuable to you when you offset that with other capital gains. Alternatively, if the value goes up and we have a sales price of 100, well, what we have is we only have a capital gain of $20. So given the choice of selling 100, would you rather pay 60 or would you rather pay 20? I think ultimately people are going to want to pay the $20 in capital gains. So again, the reason why we're looking at a high-cost methodology is that it's going to reduce, it's going to reduce the taxes when prices are high, and it's going to maximize the losses when you have a share price that's gone down. Now, LIFO and FIFO, again, the last in, first out, or first in, first out methodology, what's going to happen with your taxes there depends on what the price has done. So if the price goes up, and the last cost that you purchased on a LIFO method was the highest, then that's going to minimize gain. But if the last price that you, or last share that you bought was the lowest, you're going to pay the most in capital gains. So it's kind of hit or miss depending on where you bought it and where the current price is, whereas the high cost methodology always gives you, really the best advantage. Now, that method, that default method of first in, first out can be changed at any time. So if we have FIFO, we can change it. If we have high cost, we can change it. The default method is not an irrevocable decision at all. But after the trade is done, the cost basis methodology cannot be changed after the trade has settled. So if we go into a trade, use high cost, and then later we say, we would have been better off if we would have used a low cost methodology. If the trade is already settled, you cannot change your mind. It is etched in stone, and that's essentially what the custodian will be reporting to the IRS. Now, over the years, especially if you've had securities that have been held for a long time, you may ultimately not know what the cost basis is. Now, in the legislation, it requires the custodian to transfer information on covered securities to a new custodian when a transfer occurs. So if you have a stock at Merrill Lynch and you transfer those shares to Voisard, well, if it's a covered securities, again, following that schedule that we looked at before, they are supposed to send that cost basis information to us and to Schwab. It doesn't happen on uncovered securities. And a lot of times if you have really old securities or if you held them for a long time, you may not even have the cost basis. You may not even know where to get it. So what are you supposed to do in those cases? Well, the best way is to go back and determine where the security was purchased and if the cost basis is actually missing. I mean, sometimes what we find is that the custodian purchased it, but somehow the cost basis just didn't make it to the system. And so it might show up that you don't have cost basis, but you actually do. So find out if it's actually missing. Go back and look at and review, your original statements, original confirmations from, from the broker that you purchased it from. That'll have your cost basis information. And if you can't find it, consult with somebody, your tax advisor, specifically on how to proceed. The IRS is kind enough to give us some guidance here, and it says use a reasonable approach to determining cost basis. Well, reasonable is a fairly subjective term, and they may or may not like what you do. But I think if you use an estimate like your average cost for the day of purchase, so you might take your high cost and your low cost for that day, or you look at some historical stock data and say, well, I think I bought it in February of 2002. Here's what the average price is. As long as you use a reasonable approach and document the methodology in case it's ever questioned, you should be okay in the eyes of the IRS. It just, again, it has to be reasonable and logical. So that's what you do if you can't find the cost basis. So that we don't find ourselves in that situation, ultimately, let me skip back here just a second. Ultimately, no matter where the cost basis is, you're responsible. You're still responsible for all purchases and sales. It doesn't matter if it's a covered position or uncovered position. Ultimately, the IRS believes and says that you're responsible for those, those securities sold and that cost basis. So to help us avoid this, save your security purchase and sale documentation. For those of you that work with us, I know we have some people that don't work with us currently that are on the line, but for those of you that work with us, your security purchase and sale documentation, we have a copy of all that on your behalf. So it's not necessary that you save it, but again, it's always a good practice. If you have automatic reinvestment plans, keep those records. They put deposits into your account every month or every quarter. Keep records because you don't want to pay taxes twice on those investments. And make sure, lastly, that the custodian, whoever you're using, is using the accounting method of your choice. So that's that first in, first out, high cost, whatever methodology that you would like to use. Now, I think as much as we sometimes don't like new legislation, I think there are some ways that people can ultimately benefit from it. And first, I think the tax preparation for people that are doing their taxes and tax preparers should be easier. I mean, after all, the gain-loss information that you're going to have is right on the 1099-B. Now, granted, it'll take a few years for this really to fully implement, but ultimately it'll be easier to prepare your taxes. I think the second thing is that the taxpayers are going to have more information about gains and losses. We're looking at a couple of things as far as online access, annual reporting, but ultimately through this process, taxpayers should have more information. And what that means then is that your year-end surprises, really ultimately can be minimized. If you know what kind of gain-loss positions you're carrying through the year, it may help you to create more and better accurate information for any tax planning that you might be doing. But if you have that information, I believe that it allows you to make better decisions when it comes to, things like, should I take money out of my IRA at the end of the year? Well, let's look at your cost basis and capital gains, and is that going to impact that as well? Because that ultimately flows over to your deductions and other parts of your tax return. So I think some of the surprises can be minimized by having more information. Now, through all these changes, we have been doing quite a bit of work behind the scenes in order to prepare